For that exciting discussion. We have one more panel, a final panel of Direct Lending Summit. And I welcome you to join us in discussing how private credit is facing a stress test. So as we are at the end of the cycle and are starting to see some first defaults, direct lending has yet to prove if it can handle a credit downturn. With names like Orpea dominating the headlines and some of the direct lenders already taking keys to some of the portfolio companies, the questions of how to stress test your portfolio, but also how to navigate the environment is as pertinent as ever. And today we're going to shed some light onto what is still very much an opaque market of private credit and gain some insight on how the industry is positioned to weather the storm. My name is Marina Irklienko. I'm an editor at Debtwire, and I'm heading up our primary debt capital markets in London. And so today we'll be exploring three things. One is how safe it is for private credit to go through a downturn. What are some repercussions of a decade-long of covenant-light and covenant-loose deals? And also, what are some parts of private credit that has most resilience in the changing environment? We will open the floor to questions in the end, and I hope you have some burning ones for our speakers. And now I'd like to hand over to my panelists to introduce themselves and say what is it that you focus on.
Sure. So, hi everyone. My name is Cecile Davis. I'm a portfolio manager in PIMCO's private debt. And as we've seen in the prior panel, private debt means different things to different people. So I'll explain what we focus on. We focus on corporate opportunistic credit, which means that we take advantage of public market dislocations, but also hunt for funding gaps and provide private financings to companies with the aim to return 15% returns and provide some downside protection to our investors.
Hello, my name is Tyrone Cooney. I'm a partner with Eris Management. We're a global alternative asset manager with about a little over 350 billion US dollars under management. Since the inception of our European direct lending fund, we have invested over 50 billion euros in Europe. Our strategy is essentially a more senior first lien strategy across different geographies. We have 6 offices in Europe currently.
Hi everyone and good afternoon. My name is Hamza Filali. I am a managing director within Morgan Stanley Investment Management. And I am an AC member of the European Direct Lending in charge of France and Southern European businesses. Perhaps a quick snapshot of MSIM, a bit less known on this side of the Atlantic. MSIM is a 1.4 trillion asset under management, of which rapidly growing alternatives with more than 200 billion. And more relevant for our discussion today is private credit and equity, where we have 40 billion, half private credit and half private equity. And that splits across a very wide range of strategies and geographies. On the capital side, be it co-invest, GP-led solutions, be it minority, energy, Asia. And on the credit side, we have definitely the typical US mid-market, lower mid-market, mezzanine credit ops, and now we are launching in Europe as well a European direct lending strategy.
Okay. Edouard Narbou, I'm CEO of ETA Financial Services. I'm not an asset manager, no investor, just a loan and debt agent based in Europe, working in Europe, based in Paris and London, 30 people. We have more than 150 billion euros of debt, not under asset management, unfortunately for me, but under monitoring only. And we work for some people here, not all the people yet. And we have, I will say, a global view on the European market and more specifically on the French market in direct lending.
So I'd like us to kick off by getting a sense of where the market is and how private credit funds are positioned as they enter what is possibly their biggest market test yet. Hamza, do you want to start?
No, definitely. As I mentioned, within Morgan Stanley Investment Management, we have a quite good view about geographies, strategies, in the US, Europe, and Asia. We hear a lot of concerns about the risk that we have been perceiving around us in the last few months. Fair to say that up to date, public data shows still very low default rates. To give perhaps also a bit of sense to people in the room, our portfolio, if we look at 2022, profitability margins are increasing at double-digit level versus 21, which is perhaps a testimony for us picking the right asset, but also tells a bit where we still stand in the cycle right now. I think, Marina, you have been, and your colleagues reporting last week a bit that we start seeing some liquidity issues in the private credit market. We hear that, in the portfolios, there is increasing share of watch list, which is quite normal in the current environment right now. But we are still confident that definitely we are not in the situation where we were in 07, 08. I think the market has been disciplined, especially on the private credit, if we compare to public markets. And we are still, confident that there will be some businesses that will have to tackle files that typically are on the more cyclical industries or on the consumer side. And overall, we do think that the managers that have been disciplined, or in our case, we have no legacy, will be able to be very well positioned to capture the opportunities that the current market is offering to managers on the private credit space.
Thank you. And Sharon, what do you think we're at in terms of the market?
At Eris, I think we're quite excited about the sort of months ahead. I think it's an ideal moment for private debt. It is true that deal flow has somewhat subsided, but still there's going to be, we're pretty convinced that it's going to start picking up towards Q2, Q3. I think now with the capital markets in the situation it is, pretty much no one's really doing major underwritings in the European market right now. Really opens the avenue even wider to direct lenders with, again, if you look throughout the geographies in Europe, almost in every single leverage market, you're seeing direct lending gaining market share against traditional banks. So future going forward, I think it's a right time to invest. You're going to get better returns than the previous vintages on tighter structures at probably generally lower leverage currently. If I look back, I think we're very happy where our portfolio is currently. We don't have any major issues in the portfolio, and our deployment has been fairly strong. I think we deployed like 15 billion euros in the past 12 months. And again, our strategy is more single investors, so we don't really like to club our deals, which gives us a great degree of comfort when we need to sit around the table with management and financial sponsors to work through any potential problems.
And Edouard, how do you find direct lending portfolios now compared to where they were 12, 18 months ago?
Thank you for the question. Just to get back to what was mentioned by Tyron, we release each quarter a very good index on private debt in France, just for you to let you know, and what we have experienced in terms of leverage and spread during the last quarter of 2022 is indeed a decrease of the leverage coming from almost five times for the third quarter to 4.3 times at the last quarter, and a decrease obviously on the spread in terms of percentage. It was above 6%. at the third quarter, and now it's close to 5.7%. And the index will be released very soon at AFS.com if you want more information. To get back to your question, thank you. What we have seen on our portfolio is, which is agnostic in terms of investors. So, as I said, we work for a lot of people around the table. So, we have noticed and experienced approximately 15% of the transaction which has or had experienced a default. Obviously, it's not it's not significant, I would say, because among the default there is always, I would say, minor things, but there is sometimes major things which was not existing 18 months ago. So obviously the world has changed. What we have seen with direct lending, and which has not been, I will say, seen with other investors, is the capacity to react quickly, to put money on the table if need be, and to avoid any long crisis where you lost trust with the management, when you lost time, and when you don't cut your arm or you don't do the right thing at the right moment. And obviously after, it's worse.
So you're not getting too many calls on enforcing securities yet?
No, no. But not yet. But that's a fair point. What we've seen during the last quarter of 2022 and already in the first quarter of 23, it's we have seen more transaction with what we call fiducie in France. So this is the French trust to make sure that some security are, I will say, put aside, and to make sure that there is a real capacity to enforce in case of, and to set up fiducie in an in bonis situation, it's quite new in the French market.
Interesting. And Cécile, do you see an increase in opportunistic credit situations, and what are some drivers behind them?
Definitely. So we're definitely very excited about the opportunities building up over the next 2 years for opportunistic credit. Again, I mean, talking to advisors, they're starting the year with 3 times, 4 times more restructuring mandates than what they had last year. So definitely a couple of leading indicators for that to happen. And also, as mentioned, in terms of, we definitely haven't seen the default wave yet, but when that happens, at the moment, it's a lot of liquidity crisis, very sudden liquidity crisis, and the need to inject new money. So on our side, definitely very, very confident and optimistic about the opportunity set. And what I would say, with regards to the direct lending asset class, which we're not, really involved in, is definitely, it's really the first test. It's a young asset class. It's, 10 years old. It's been resilient to date, but there hasn't been any major crisis. And the one crisis that we, are likely to face over the next 12, 24 months is really going to question the ability to put so much leverage on these companies. Obviously because of rising rates, but also potential earnings decline. And the excesses that have gone on in this market will definitely put the asset class to the test. I mean, you've seen a lot of, a lot of deals done on sort of on a LTV basis, looking at valuations, but less focus on the cash flow side. At the end of the day, these companies with 5 times, 6 times leverage, they have to be cash flowing to be able to sustain this capital structure. So what you're going to see in the market is really a bifurcation of the credit quality and of the outcomes, on the back of rising rates and potential earnings decline, because a lot of them will not be able to support that in a declining cash flow environment.
And Hamza, I'm just staying on the point of where we are at in the market, but also how funds are prepared to enter the stress test. So you mentioned that MSIM is quite obviously active in the US. Could you give us like a comparison? What are some differences between European market and US market in terms of private credit funds portfolios, but also how are we doing economically compared to the other side of the pond?
Thank you. No, it's a good question. It's true that very often, what happens in the US is a bit the anticipation is what will be going on a bit later in Europe, right? So as we previously said, interestingly, when we look at the data in the US, the economy is still quite strong. So, for example, we do usually look at the construction sector, and the numbers are holding up are quite solid still in the US. Even hiring numbers in the construction sector in the US, which is itself an anticipation of the construction output, are still quite strong. So there is no imminent signs of something coming over quickly, despite what we hear and what we perceive in the environment, right? So that's our first, perhaps, topic. Then, historically, the US has been slightly different from Europe because it was more clubby, more mature and more clubby market versus what we have seen in Europe, and also probably with lower exposure in fund to single transaction. And that also may be driven by the fact that in the US, they used to invest in also more cyclical businesses like oil and gas, like energy, if you compare it to Europe, where private credit had stuck to more defensive businesses historically. So it's true that nowadays we do see a trend in Europe as well of more club deals being structured, and that in light of the public market being completely closed right now, and at some point there will be a bit of catch up Europe versus the US. But on our side, even we have that practice in the US, we still do like being in control of the transaction, having that direct relationship with the sponsor, and being able really to arrange structure properly the private credit, which is a key differentiating factor versus public market, where I spent some time there, especially pre-crisis, and the term sheet and the docs on the public market, cannot be really compared of what we really managed to get on the private side.
Taran, do you have similar experience?
Yeah, pretty much. I mean, I'd say one thing is that the U.S. market is much more liquid. It's, as Hamza says, very much more of a clubby. The private debt market in the U.S. almost resembles kind of what we would expect on capital markets here in Europe. So it's quite different. It's very much a cov-light market.
But does it make it more risky in the end?
Well, it depends. I mean, like if we look at it currently, it doesn't seem to be that bad currently. But default rates in the U.S. for a number of reasons, culturally, legally, whatever, are probably a bit higher than we'd see in Europe because of the facility in which companies can go through bankruptcy and restructure debt is certainly an easier and less complicated process. But all in all, I think that Europe still remains a fairly, definitely a less liquid market, and that's why you can probably get higher returns in private debt in Europe than you can in the US.
Still an emerging market. So picking up on that point of covenant light, obviously in the environment of abundant liquidity, stiff competition of recent years, we've seen inevitably erosion of terms and documentation, including what has now been almost a decade of covenant loose, but also some of the covenant light deals. And now, as we're entering a downturn, what is the aftermath of years of covenant light deals? So do you want to take that?
Yeah, I mean, so it's obviously a problem. It's a problem for the recoveries, and just anecdotally, our analytics framework, which we use internally to price a bond or a loan and come up with its fair value, we've actually just at the beginning of the year, so 2 weeks ago, lowered the recovery rates of senior secured rate from 70 cents to 50 cents because we think the recoveries are potentially going to be lower. So again, to me, the issue is not just Cov Light or not, it goes way beyond that. And the first and foremost, it's credit selection. Credit selection, is the best protection you can get, because ultimately, if you invest in a bad business with limited downside protection, but you have covenants, it's not going to make it a good investment. It's not going to help you out in terms of recoveries. So, first and foremost, credit selection. And then, again, goes beyond just the financial covenants. It's looking at the documentation overall. And again, documentations can be quite tedious. So I won't bore you with all the details, but it's definitely looking at the ability to make distributions to the sponsor. It's looking at the ability to raise pari debt, priming debt, the ability to move assets in and out of the restricted group. It's things like that, unfortunately have weakened over the past decade because of the competitive environment for that asset class. And, ultimately is likely to lead to lower recoveries, in our view.
Do you agree?
Yeah, well, I quite agree that people used to, people are in general focused on these topic, Cov Light, Cov Loose, but at the end of the day, you have to look at the dogs as a whole, because there are so many other things that you should be looking quite closely at, baskets, permitted indebtedness, and so on. So that first. So we are looking at covenant in combination of other topics. In my view, there are two other topics that are important as well. One, especially in Europe, given different geographies and cultures, one is legislation and insolvency regimes. So we said that definitely on the covenant side there have been a bit worsening or less protection, but fair to say that legislation typically in continental Europe are improving and more lender-friendly, which is good news for our business. And the third topic, or the second, which is a mitigant to the covenant, is actually the culture and how people have been behaving in the last few years, and which is super important in my view as well. And I do think that people have taken the lessons from 0809 to some extent, and definitely there have been sponsors and clients that have been also disciplined themselves in the way they were structuring their transactions. I like to give this example, which was like last spring when we were finalizing a transaction and we were signing a commitment docs. And I received a call on a Saturday because the discussion between management and the sponsor just after the Ukraine invasion and some more risk perceived by the client, they asked us to reduce the leverage by 25% over the weekend, and we signed the docs on Sunday just because the sponsor and the management were willing to protect their business in a more volatile environment. So that's something important to have in mind as well. And when you look at the covenants at the docs, you have also to think about who is your client, who is your customer, the partner you have in front of you, what kind of partnership and relationship you have been having with these sponsors. And we do have now enough data since the last 15 years plus with those that have been behaving fairly well and those that have been behaving slightly less well. So that's also a number of parameters to take into account.
Taran, what's your view?
Traditionally, we've been a very covenant house, so we don't do Cov-Light deals. That being said, covenants from our perspective has never been one where you just go ahead and take the keys. You just bring everyone around the table to negotiate, and it'd be management team, private equity sponsors, and the debt provider. But I think covenants is one thing, and certainly tight docs, tight definitions of EBITDA, of add back, synergies, whatnot. And I totally agree as well with Cécile said, you cannot structure around a bad deal, meaning, you know, you can't say, well, this deal kind of has some warts and whatnot, I don't really like it, it's kind of hairy, but I'm only doing 2 times leverage. No, that just doesn't work. You know, I think you need to be really, really careful about that. But where I kind of want to point people's focus on is the GP's ability to manage correctly the portfolio on a daily basis. Because, you know, covenants, they may never come to hitting covenants or whatnot. But look what we're going through now. High inflation, high energy costs, raw material costs, interest rates. So the ability of the portfolio team to go through their portfolio and measure and sensitize the impact that this is going to have. To give an example, what we did at Ares is we sensitize each of our funds vintage portfolio and stress how high could the interest rates go, base rates, before, say, our interest rate cover starts getting a bit stressed out. And in our portfolio, our latest vintage, which is ACE 5, which is what we're investing in today, the base rate would need to increase by 600 basis points before there's any sort of stress. We haven't seen that in over 20 years, and I don't think it's going to happen, hopefully, anytime soon. But you know, and I think that's that sort of analysis that is really important as well. Is just to make sure that the GPs have their pulse on the portfolio, not just sort of covenant focused or other. But yeah.
And Edouard, what kind of issues do you see most often in your practice? Is it covenants, EBITDA adjustments, documentation?
To get back to the point of Tyron, indeed, what we see today is more time, obviously, spent on the portfolio management to analyze what could happen. The covenant, obviously, is key for the investment, but you're right. It's not the covenant which makes the investment correct. It's the business itself. And when we discuss about covenant with the investors, basically they anticipate by 6 months or more what will be the covenants. So obviously there is breach in covenant today, and there will be more. There will be standstill, covenant holiday in case. To make sure that they have time to negotiate. But as of today, we don't see a panic around the management of the different portfolio we work on. What we see and the discussion we have is basically investors are cautious. They do stress tests on their side, obviously, but there is no. Clearly, there is no panic, and there is still money to invest. There is still a will to invest, but not investing in any kind of asset. I will say, not trophy asset, but the most attractive asset, which also has a consequence, which is the decrease of the leverage, but it's much more the philosophy of the moment. But the fact that there is perhaps more competition on the few assets on the market today, so obviously the spread are also decreasing. So that's what we see today in terms of I will say management of the portfolio. And as we said earlier, when we say taking the keys, that's a key point. If need be. To avoid any misunderstanding here, investors will take the key if they have to, because there was 5 or 6 years ago a fantasy about France, more specifically. It's difficult to take the keys, it's difficult to enforce security, always difficult. But there was transaction in the past in France where investors took the keys. So people know know now that it's possible, it's doable, and there is less this, I will say, this bad image of France, you know, where everything is impossible in terms of debt restructuring. We have seen a lot of huge restructuring. It started with Bourbon, recently with Pierre et Vacances. So there is clearly likely, there is a possibility to take the keys, and they know how to do that.
So you mentioned there is no panic yet, but given all the headwinds that Tyrone mentioned, do you think there comes an inflection point where they take a full effect and the companies will actually feel it quite painfully, and that's when it translates into a wave of defaults that we might not be seeing now, but can you maybe estimate when, if at all, that might happen?
Never? No.
Well, that's bad for business, no?
No, help?
I think we need to define what is a default, because a default could technically be they breach their covenants. If you're speaking about a payment default, well, then that's, you know, again, generally a proper management team would be able to see that coming and say, well, I might have a liquidity, and the way we structure in most private debt funds will structure a senior loan is they can have an element that can be picked. So you can, you know, relieve some of the stress on the cash. So again, covenants are a way to get people around the table, but I think everyone's interest is kind of to avoid that sort of point of no return default. And I think that's really where I see very little in the current market. I haven't seen really that much risk around the sort of point of no return.
What we've been hearing from the market is the general expectation is that 2024 would be the year is when we actually see some of those deals going south. But time will tell. So going a bit more optimistic, obviously given where we are in the cycle, what are some most resilient corners of private credit? Where would you put your money?
Well, definitely in good credit. I think Cécile mentioned earlier that we have seen some practice by some managers, perhaps less focused in fundamental credit analysis and looking typically more to LTV, sometimes lending on a basis of top line or whatever. This is definitely the time where you have to be focused on cash flows, and you know, and we are a believer that we are cash flow lenders, and also it is a time where you have to be back to, yeah, as I said, basics. So variable cost, fixed cost, ability to keep costs under control in a environment where inflation would put some pressure on margins, right? So I know that people tend to say software or whatever, but you know, there are different software businesses and there are different business services companies as well. And definitely you need to spend more time making due diligence and modeling different risks that are still around us and ahead in the next few months. And this is what we said, that in our view, people that are less focused on portfolio, in spending time more or less dealing where soft or hard restructuring in their portfolio will be better positioned to be focused on the new opportunities and to analyze properly the opportunities that are still interesting in the current market.
Cécile, is opportunistic credit more resilient than direct lending?
So in terms of resilience, I think it's probably equivalent for a couple of reasons. Well, first, I would also insist on the risk return. I think, again, what we're talking about in direct lending, I think this is not an asset class issue. This is more maybe a vintage issue also. You know, obviously, if default rates increase and recoveries are lower, that's going to erode the returns. And the question is, what's the relative value versus other asset class, including liquid or including, opportunistic credit, for instance. So I think there is a risk-return question, but not an asset class question. And yes, I mean, from my perspective, and I've been doing that, for several decades, is one of the best time to actually invest in opportunistic credit. So it's a risk-return point. We see more demand for private capital. We see obviously direct lenders retrenching from a lot of sectors and obviously focusing on a couple of more defensive sectors, healthcare, software, and therefore that leaves a lot of white space for lenders like us to get a premium for providing that capital without necessarily, again, taking on incremental risk or significant additional risk. So I would just position it more on the risk-return standpoint.
And to wrap up our discussion, what would be one piece of advice you would give to a private credit investor when it comes to managing your portfolio in the downturn whilst having to deploy? Taran?
I'd say it's pretty much what I said earlier. Just make sure that you have a very active dialogue with your GP. Ask the tough questions. Put your fingers on what their watch list looks like, what the monitor list looks like, how do the cash flows look like in the current environment? Have they stress tested, as we said earlier, taking into account inflation, interest rate increases, and just be on the phone a lot to your GP and just really monitor. Make sure that your GP is managing your investment well.
Do you echo that?
Yeah, totally agree. I would add just a couple of points, quick ones. One is is a young industry, private credit, and we have seen also some significant movements between fund managers recently in the last couple of years, so 2-3 years. So if I have one piece of advice for GPs is to look at track record beyond the firm for senior investment professionals, to look back as far as possible, if possible before the financial crisis. We start getting some interesting data points on how people have behaved in the last 15 years, how they have dealt with restructuring, how they have supported and went through restructuring processes. So that one piece of advice that I could give. The second one, which is also super important in my view, I would say avoid one-man shows in some funds. Governance is super important and will be increasingly important in the funds. So you have to be sure that there is a good people are properly incentivized in the teams, empowered, and then there is a good governance in those fund managers. And that the strategy, the fund you are investing in, is key in the heart of a business, of a strategy, and it will be supported on the longer run. So that's some elements which are quite key in my view for an investor.
Thank you. Edouard, what's your advice?
Just make sure that the GP has the right agent, the proper one, obviously. I'm not really here to give advice to LPs, but I obviously agree with what was mentioned. We've seen different situations of restructuring, and obviously when you go to restructuring, you see when people know what they are talking about, and when you deal with people who don't know because they have never been exposed to this kind of situation. And restructuring, it's a specific business, specific code, specific knowledge, specific experience. So obviously, I will say make sure that in this current environment, make sure that there is a team with people experienced with this knowledge, because if you don't know, obviously everything is a question, and you could create panic, whereas there is no reason for, even if the situation is not easy, obviously. So to get back to the governance, the team, and obviously it's not the GP who makes the experience, but the person itself.
Cecile, what would you recommend?
I definitely echo that. I would say, I mean, definitely the LP community is now highly sophisticated for that asset class. And so, I mean, in terms of questions for due diligencing the portfolios, it's also understanding also the portion of the portfolio that has hedges in place to deal with the floating rates instruments and the rising rates. It's understanding the tail of the portfolios, understanding whether they've stayed on track with the strategy, i.e. still senior secured and didn't venture into subordinated debts or private equity. It's it's all these questions on the due diligence side, and I would say then definitely on the team and process side. So team, do they have restructuring capabilities? And on the process, how are the decisions taken? How are the are the incentives aligned in the team? Is the idea, to deploy a lot, to grow AUM, to benefit the equity value of the platform, or is it to actually, be disciplined and make proper investments, and be a long-term platform?
Right. Do we have any questions from the floor? No? Well, it looks like it's time for the drinks. Thank you so much, my panelists.